I'm going to share with you the 5 steps that I follow to successfully purchase rental properties. Hi, I'm Jim Ray, and this is my rental property retirement channel. It's where I share with my audience how I'm building my rental portfolio in order to fund my retirement. Now stay tuned and watch this, because in this episode, I'm going to share with you the 5 steps I take to purchase successful rental properties. Now let's take a look at what I'm currently doing, right? So here it is, 2024. It's 10 years after I did that fix and flip over in Texas. And now here I am. I'm getting closer to retirement and I'm thinking, man, I need to build up my portfolio again. So what am I going to do? Well, I'm going to walk you through the 5 steps. Now, step number 1, I need to know what my end goal is, because that's really going to dictate what I do and how I get there. Just as if you're driving to a destination, you need to know that final destination so you know which route to take, right? So if you don't know where you're going, you have no idea how to get there. And so for me, I've kind of carved out and identified what my goals are. So number 1, I want to generate some wealth. And what do I mean by that? Well, I want to increase my real estate holdings. Now, I do have some rental properties now, but I want to bring that up to the next level. In addition to bringing up my portfolio, I also want to be able to generate more monthly income. And that's going to come from renting the properties out and collecting a monthly rent from the tenants. My goal is to own $2 million worth of rental property over the next 5 years. And I also want to create an additional $5,000 a month in cash flow as rental income from those properties. So now the question becomes, well, how am I going to get there? Now there's 3 basic or primary real estate investing strategies that I want to share with you. Now there's actually more, but I want to show you the main 3 that typically get talked about and utilized, at least from my perspective. So number 1, there's wholesaling. This is where a real estate investor gets a property under contract, right? So they go out and they find homeowners that are willing to sell their properties, and a wholesaler will come in, get that property under contract with the seller, right? So the seller wants to sell the property, the wholesaler gets it under contract, and then they turn around and sell that contract to another investor. The second way is fixing and flipping, which is very popular on TV with programs like HGTV, where you see individuals or couples going in, buying properties that are in a distressed state. They give them a facelift not only on the outside, but they renovate the inside and they turn it into this beautiful showcase home. And then they turn around and they sell that property to a new buyer. And they sell it to the buyer because now it's a turnkey property ready to go, right? It's all cleaned up. Everything's been fixed and rehabbed. And so it makes it easy for the new buyers to come in and fall in love with this beautiful home, right? It's got all the curb appeal. It's got all the latest fixtures and appliances, and it looks absolutely stunning. And we see that a lot on TV nowadays, right? So these are fix and flips. And then the other way to do it is to buy and hold a property, which is what I like to do now. And you've seen it in my portfolio where I'll buy a property, I'll clean it up, and then my goal is to rent it out. I want to put tenants in place and then collect that monthly income from the tenants as they pay me every month. Now that gives me the ability to pay down my debt on my mortgage. I get the tax credit from the depreciation. I earn more equity as the property appreciates, and it also generates some income from the cash flow, right? The tenants coming in. So for me, it's going to be buy and hold. So my goal is to own $2 million worth of rental property within the next 5 years. I want to have an additional cash flow of $5,000 per month, and I'm going to be using the buy and hold strategy. Now for step number 2, it's all about the location. Now, where do I want to invest? And this comes down to the real estate market that I want to target. Now, ideally, I want to pick a location that's convenient for me. Now, what's convenient for me is exactly where I live. And the reason for that is I know the market already. I don't need to do a lot of research. I know which areas are hot. I know which areas are very appealing. I know which areas to stay away from. Plus, it's also going to be easier for me to manage. If there's a problem on the property, it's easy for me to just drive over, right? Could be half an hour away, or identify the problem, find a solution, and then get it implemented. Plus, I can self-manage the property, and it's convenient for me to just check in with the tenants or the property if any type of problem arises. But a convenient location that's close to me may not always be the right answer. You also have to look at rental properties from the business perspective, right? So does the market area that you're choosing support the strategy that you want to use? What do I mean by that? Well, for example, if I'm going to be doing, say, short-term rentals like the Airbnb model, the properties that I have need to be in an area is conducive to short-term rentals. If the market I'm choosing is in the middle of nowhere and there's no attractions or anything to draw people in, it doesn't make sense for me to use the short-term rental strategy in those types of areas, right? I want to be in those popular areas. I want to be in areas that have a lot of tourism. So beach communities, areas with large attractions, destination resort areas. Those types of markets will actually support short-term rentals versus being in the middle of nowhere where there's no reason for people to come in and out. Now I can have the Airbnb, the short-term rental there, but I'm going to get very low traffic, and so that's not really going to work out for me. Similarly, if I want to do, say, fix and flip, but I happen to live in a small town or a small community, I'm going to have a harder time flipping that property if there's a smaller community, right? So I want to make sure there's a large enough population so that if I do flip the property, there's going to be a market demand or a need for properties for people that want to buy the property. And so it requires me balancing that out, figuring out those areas that will align with the strategy that I'm interested in pursuing. Could be that the market area where I live is too expensive, right? So I live in Southern California. Average home price, not $400,000, but it's closer to $600,000. So it may not make sense for me to acquire a rental property here, knowing that I won't be able to make a cash flow because the housing price is so high, I'll never be able to collect enough rent to cover the cost of owning and operating that house. Or as I mentioned, the market may be too small, right? If I'm living in a small little town and I'm not able to flip the property because there's no demand for it, then I'm going to be stuck with the property. Now, it's not a bad thing to hold on to the real estate, but I have less of an opportunity. The property's not as liquid. I won't be able to sell it as easily if there's no market for it. I mentioned the good and bad school district, right? If I'm looking to own rental properties that cater to, say, young families, well, what are young families interested in? Well, those parents are interested in knowing that the area where they buy their house aligns with a good school district, right? They want to have good schools in place or a good school district in place so they know that when they send their kids there, they'll get a good education. I also want to look at the crime rate. I may not want to buy a house in a war zone, right? Because it's going to be hard for me to attract buyers or renters in to buy the house, right? If I'm a fix and flipper, it'll be harder for me to bring prospective buyers in because they may not want to buy in a war zone. Likewise, if I'm a long-term renter, or if I'm interested in long-term renting, the renters may not want to live in an area that's a war zone. So you got to look at all of those factors as part of your market analysis. So it may require investing out of area, right? So I may not be in Southern California. Maybe I have to go to Northern or Central California, or maybe I have to go to a different state. I have to look at all these different options to identify what's going to work best for me, because there may be better opportunities out there. Either the prices are better, it aligns better with the strategy that I've chosen. And so as a real estate investor, I have to take a look at those different variables and figure out what's going to work best for me and my strategy. And again, my goal is property appreciation, right? So I've got to get to that $2 million mark within the next 5 years. And I also want the cash flow coming in to give me that additional $5,000 per month. Well, now, because I am going to be looking at investing out of state, that means I need to have an away team because I'm not going to be able to be on site, whatever that market is, all the time. So I'm going to use something called the Core 4 to help me with my long distance real estate investing. Now, if you're not familiar with Core 4, it's a term that I've copied from the Bigger Pockets website. David Green in particular talks about his Core 4 team. And so all I've done is copy and mimic what David Green has done at the Bigger Pockets site. So let me tell you what that consists of. So number one, there's a real estate agent. Now this person, this agent is the one that sends me properties, potential properties. And so this is what we call the deal flow, right? So once I have a market, I'm going to use a local agent to send me properties in that area that kind of meet my criteria. And that's going to be my deal flows. Those are the properties that are going to be coming to me that I need to analyze as potential buys for me that meet my criteria. Next, I'm going to have a loan broker or a lender. I want to make sure that before I get to the market, I get pre-approved, because there's no point in me looking at a $500,000 house if the only thing I can get approved for is $300,000. So you want to make sure that you're pre-approved before you go looking at these houses or while you're looking at these houses, so you know what your kind of maximum is. You don't spend time, wasting time looking at houses that you can't possibly afford or qualify for. So talk with your lender, talk with your loan broker, figure out what you can get pre-approved for, and that'll help you narrow down the search for the properties. Now, as you talk to these lenders and brokers, you want to make sure you get good loan terms that will match with what you're looking for. So for me, I want to make sure that it's going to be I'm looking for a 30-year conventional fixed loan. I'm going to be putting 25% down as an investment property. I want to look at the interest rate. I want to make sure there's no prepayment penalty in case I want to do a cash out refinance, or I just want to refinance because the interest rates have dropped. I want to make sure I'm not penalized for doing that. Number 3, I need a property manager. If I'm going to be owning a property out of state, it's going to be harder for me to manage that property if I'm one state away or multiple states away, in a different time zone. And so I know there's folks that do the property management or these long distance properties themselves. For me, I think it fits in what I'm looking for, is to have someone manage the property for me. Now, I realize it's going to cost me a certain percentage, say between 8 and 10% is what I'm typically used to, depending on the property and the types of services. But for what I'm looking for, that aligns with what I want, right? So I factor that in as part of my monthly expenses, the property management fee. So I use that as part of my analysis. When I look at a deal, I factor that in, the cost of the property manager. And then number 4 of the core 4 team is a handyman or a contractor. Because when I buy the property, there's probably going to be some initial cleanup or fixing or repairs I want to do, some initial rehab, maybe painting or swapping out the floors or something of that nature. So I need someone on site that can do that, unless I'm willing to go to the property itself, right? Travel to the property, do that myself, get some hands-on and do some of that renovation. Well, if I don't do it, then I'm going to need someone on site that can do that for me. So I'm going to use a handyman or a contractor. And likewise, as time goes on, there's the operations and maintenance of the property that the property manager is going to be doing, right? Overseeing that. But if a problem comes up, a faucet breaks, if there's siding that's coming off the wall, or there's flooring that needs to be repaired, I'm not always going to be able to drop everything I'm doing and go out there. So I need a good, reliable handyman or contractor that I can utilize to help me with the physical maintenance of the property itself. And so that's where the handyman and the contractor comes in. So all of these 4 individuals, right? The real estate agent, the lender or the broker, the property manager, and the handyman or contractor, these 4 individuals, or it could be more, right? So I may have multiple handyman available, and they may specialize. One may be a plumber, one might be an electrician, one of them could be carpeting or flooring and painting. So those are the 4 categories or types of individuals that I'll need that'll help me manage the long distance property. So for me, these are must-haves, right? If I'm going to be investing in a long distance property, I need to have these. Now, not everybody's like me. They may only need 2 of the 4 or 3 of the 4 or whatever it is. It's just for me and my style. I want to have that core 4 team. Now, once I get that core 4 team in place, I'm going to start getting deals, and I need to start looking at the deal flow. Now, as the real estate agent starts screening properties, they're going to start sending me these opportunities. So this is part of the deal flow, and I'm going to need to start looking at them to identify which properties I want to take a look at as possible buys. Now, in step number 4 is where I analyze the deal flow. So the real estate agent's going to send me potential properties for me to own, and I want to make sure that they really meet my criteria and that the numbers work out. So what do I do here? Well, I need to figure out what my buy box is. And what do I mean by the buy box? So my buy box are the properties that meet my criteria. Now, I'll probably give my real estate agent a first look, a rough idea of what my buy box is, right? So maybe I'm looking for single family homes, 3-bedroom, 2-bath that are under $300,000. And so my real estate agent can screen the properties, not only on market, but maybe there's pocket listings that are off market that meet this criteria. And my agent can start sending me these potential deals for me to look at. Now, what I'm going to want to do is start adjusting my criteria of my buy box so I can really narrow in and focus on what I'm looking for. So there might be things like physical aspects, right? So maybe I want a single family home that's only 1 story. I don't want a 2-story. Now, I could tell my agent that obviously only send me 2 stories or only send me 1 stories. But I think what I found is if I restrict my real estate agent too much, I may miss out on some deals. And so there's certain things where I'm willing to take an extra minute and I'll do that secondary screening myself. So even though I'm interested in in single-story homes, I found that sometimes I'll have my agent send me both single-story and two-story homes because there may be something that catches my eye. It may be unique construction or something or a location, or I think, you know what, I'd be okay buying this home even though it's two-story. So keep that in mind. There could also be some environmental things you want to take a look at with the home. It could be the ideal home, but it might be at the bottom of a hill, and maybe you don't want that, either because you could have neighbors above you that have visibility down into your property, and maybe you don't want that because you're a private person. Or maybe the property is lower on the floodplain, and so it might be subject to flooding. So you're interested in having a property that's at a higher elevation, so there's less risk of flooding to your property. Or the property itself could be too close to a freeway, so there'd be lots of road noise or railroad tracks. So these are some of those environmental factors that help you decide whether or not the property is right for you. Again, the house may be perfect. It might be that single-story, single-family home, 3-bedroom, 2-bath, under $300,000, picture perfect, ready to move in, but it's located right next to railroad tracks, or it's located right next to a chemical factory. And so that may not be ideal for you. So you want to make sure you look at those environmentals. And then also, as a part of that, you want to look at the amenities. What are those things that you use on a day-to-day basis or on a frequent basis that you want to have access to? Maybe it's the grocery store. Maybe it's a hardware store like your Home Depot or your Lowe's or your Ace Hardware. Maybe it's closer to schools. So you want to take a look at all of the amenities that you might be using and make sure they're convenient or at least accessible to you. So my point is, you need to look at the house, not only for the house itself, but some of the other outside influencing factors. Now, when the deal flow comes in from my agent, I'm really going to hone in and focus on only the interesting ones. And those interesting ones are the ones that meet my initial criteria. They've got the right physical attributes, the environmentals work, as well as the amenities. And now I can really start drilling down and taking a look at those properties, right? So I'm going to be looking at the purchase price. How does it work with the loan I'm looking for? Or will it work with the loan that I want to get? I want to look at the expenses of that property, right? So there's property taxes, there's homeowners insurance. Depending on the age of the house, I may want to set money aside for a new roof because I know that the roof hasn't been changed in 30 years. And so I may buy the house knowing that I may need to change the roof, in the next year or two. But I need to look at that and be aware of that that's something I want to factor into it, as well as the rental income, right? So what is the current market rents that are coming in? What can I expect to get for this particular rental property? Now, taking all these factors into account, purchase price, expenses, upcoming expenses, right? Planned expenses, like I said, there might be a new roof or some ongoing or the regular day-to-day maintenance. Things are going to break. Light bulbs, garbage disposals, things of that nature. They're going to have to be changed and repaired as part of being a landlord. But then you also take a look at the income that's generating for you from the tenants paying their rent, their monthly rent. So from here you can calculate what's the cash on cash return and also what's my cash flow from the property itself. Now for the properties that I find that meet my buy box, it's time for me to take action. And so what I want to do is make an offer on that house, right? It's in my buy box. It checks all the boxes. It's in the right location. It's got a great configuration. The environment is perfect for it, right? It's on a hill. It's close to services that I like. And the property makes financial sense, right? So the income that it generates will cover the expenses that I have, and I'll be able to get a little bit of cash flow from it. If everything's looking good, it really does check all the boxes for me. And so I want to go ahead and talk with my agent and submit an offer for the property. So there you have it. Those are the 5 steps I use to purchase rental properties. Which step are you on? Or better yet, tell me what steps you follow. What do you do that's the same, or what do you do that's different? Let me know the steps you use to make yourself a successful real estate investor. Leave me a comment below with your reply.